Welcome back to another episode of What's on Your Mind. The festive season is almost upon us, and who better to have on the show than our US mentors, Malhotra and Berggreen. Guys, fantastic to have you on the show. Now, all I want for Christmas is some good trade ideas, something you guys have in stacks. So let's see what you've been thinking about. And Raj, why don't you kick things off?
All right, great. Well, to start off the festive season, I'm going to come up with a short in a company that might go to zero. So I guess I'm going to play part of the Grinch in this program. But before we do that, I just want to kind of let everyone know in perspective. Like if you look back, even though with all this volatility recently, the market is essentially, as we speak today, flat since September 1st, despite a lot of the intraday big moves. So I continue to look for longs and shorts, and I fully believe that there's so much. There's a lot of negativity, but there's also might be some green shoots. So you can look from both sides. You should be able to find something on both sides, long and short, going forward. So I'll start with a short, and this one's a pretty simple one, and it's been kind of known. It's Coinbase. Ticker is Coin, COIN, and it's, as you probably know, it's the largest crypto exchange in the U.S. by trading volume. As we speak, the price is around $44, and the market cap's about $10 billion, which is lower than shorts that I usually look to. But there are exceptions to that rule, and this is, in my mind, clearly one of them. The PE couldn't be more negative. They don't pay a dividend because they lose money hand over fist, and even stock down year to date around 80% and still growing. I still think it's a name you want to avoid, and certainly can play to the short side. So let's go back to the most recent earnings report, November 3rd. And keep in mind, this was before the FTX and BlockFi bankruptcy. So these are the numbers that had nothing. They had no bearing on these earnings numbers at all. So they reported a EPS loss of $2.43 versus expectations of a loss of $2.23. So bad and even worse than bad. Their revenues were $590 million versus expectations of $642 million. Again, a bad miss. And if you look at Q3 year over year versus last year's Q3 in 2021. The revenues fell 55%. So all of it is clearly going the wrong way. And this was before any of the very negative and amusing headlines coming out of FTX and what's going on in the Bahamas with not just the losses, but all these nerd orgies. So my thesis is pretty clear. I've been bearish on this company for a while, even the stock, well above $100. And now I'm more convinced than ever. And it's very simple. Problem with the company's business model is it just doesn't work. If you look initially at the FTX bankruptcy, some market pundits were talking about how it's positive for Coinbase, given that with FTX gone, that's one competitor gone, and they should gain market share. Now, I totally disagree with that. Let me tell you why. And the point that they were pointing to was that Coinbase trading volume spiked post the bankruptcy. And that's true, but I fully believe that that's because everyone was liquidating their crypto. Once you're out of everything, there's no more reason to trade something. So, so now even if they're left with a larger market share, a market share of what? I believe that revenues into cryptos are likely to fall off a cliff for retail. Because let's face it, how many of these people that are actually trading and buying it knew what it did or why it was what it was worth? People were simply buying it because they thought it was going higher and into the moon. And that narrative is completely flipped. So I don't know the exact number, but estimates is very high that most people that were trading it have no idea. And now that they will just stop trading it, and probably likely so. Like whether it's Coinbase or any stock we talk about here or in the market, you don't want to trade something where you have no idea what the fundamentals are, why a company's doing what it is. So there's no reason to trade it if you have no idea what you're going to do, and you're probably going to lose money. So anyway, in terms of that narrative, another thing that I really, really wanted to point to, and I looked at this in the 10Q because Coinbase right after this bankruptcy was stating that your assets are safe. I don't believe that's true. And I actually went through the 10Q and I found the disclosure. And I want you to really pay attention to what they said in this 10Q. I'll put this up on the screen here, but I'll read it here. It says, because custodially held crypto assets may be considered to be the property of a bankruptcy estate. In the event of a bankruptcy, the crypto assets we hold in custody on behalf of our customers could be subject to bankruptcy proceedings, and such customers could be treated as our general unsecured creditors. So what does that mean in English? That means if we went bankrupt, the assets we held in custody on are not yours. They could be basically they're ours, and then you'll be treated as creditors if you want your crypto back. So, that's essentially what happened with FTX. And while they claim that that's why they're different, and maybe they are a little bit, they're not as poorly run or as I don't believe they're engaging in criminal activity like FTX did. They certainly have the same issues if there's a run on the financial institution and on crypto, even though they're not doing anything wrong per se. It's just that's the way they hold their assets. And like I said, a run on it would basically bankrupt this company. And how do you get your money back if there is no money? So more important, another thing too is, given the bankruptcy of an esoteric exchange like FTX, there's other companies that are coming into this crypto space that you can trade. And quite honestly, I'd much rather trade with. Like, for example, Interactive Brokers. Interactive Brokers, they charge an average of 15 basis points per transaction. And Coinbase was charging something around 1% per transaction. So where would you rather trade it? If it's paying 1%, or rather paying 15 basis points? Furthermore, even if the costs were the same, would you rather trade it at a well-known broker that's well-capitalized like Interactive Brokers, or even Fidelity that's just getting into trading crypto, or some company like Coinbase that doesn't even have office space and they have no reputation and they have no money? So you'd be a fool to trade crypto at Coinbase if you really knew what you were doing, because why wouldn't you just trade it at somewhere else where in a bankruptcy you're likely to have some protections? So, I mean, the simple answer is Coinbase is running an expensive operation. They're offering a commodity-like product in a shrinking market, and they have no path to profitability. I mean, while this business model could work in easy monetary environments like in the past, when free money's out there, it's unlikely to work in today's higher rate environment. The risks are massive. And even if you were bullish on crypto, this company, in my mind, is a short. Coinbase fundamentals were a tailwind to stock when Bitcoin was at 60,000. Remember, commissions go one way always. They go lower. And there's no way, there's no payment for order flow or anything else to make this work for them. The company has stated, if you look at their fundamentals or their balance sheet, they've stated that $5 billion of cash on hand, and they're holding $95 billion in crypto assets. So once those start getting liquidated, it's unclear if Coinbase could actually handle all these liquidations if everything was liquidated at once. So are there some risks to my short idea? I guess it is cheap on historical metrics like sales multiples, but that's based on past revenues on a 2-to-1 sales ratio. But, I don't know how anybody can claim that crypto transactions will be higher in 2023, given what's happened in the last month here. So the bottom line is this business model is in structural decline even before FTX, due to competition, rate pressure, and lower altcoin volumes. The FTX implosion puts immediate pressure on the company to capitalize with money that they don't have or they can't raise. The management can't cut costs fast enough, which they're going to need to survive, because anything they need to stay in business, they're going to have to spend more money on guardrails and compliance and regulation and all that stuff. So they're losing money hand over fist, and I don't see how this reverses unless crypto reverses hard. And even if you believe that, which I don't, but even if you thought that Bitcoin could triple here, you'd better off just buying Bitcoin than holding Coinbase, because it's just not sustainable in this model. Like, when the stock market doubles, commissions don't double; they still are the same. So I believe on the bright side, I do believe the demise of these exchanges could actually ignite the power of the blockchain, because I do think there are some positives on that, but let's not get ahead of ourselves in this idea here. So in terms of how to trade this, next earnings are February 2nd, and I think that's going to be obviously a pretty big catalyst to really show the future of this business. I simply like buying puts out to February. I like buying very downside puts because I do think there is a potential for this company to become obsolete and it might be apparent rather quickly. If you look at the February 30 puts, they're trading around 280. The February 25 puts are trading around $1.70. You're really bearish. The February 20 puts are trading around 90 cents. There's a lot of convexity to these options. Once this goes, it could go quickly, similar to what's happened with Carvana today, if you were talking about this. But, there is like those downside puts with convexity have potential to really increase massively in price. And that's kind of what I have here on that.
Cool. Thanks for that, Raj. Well, from one Grinch to another, Ben, let's go over to you. What have you got for us?
Yeah, I actually have another short as well. But before I get cranking on that, I totally agree with Raj on Coinbase, because if Bitcoin, other cryptos just continues going down the tubes, and Interactive Brokers, let's say, is involved, for them it's a tiny speed bump because their biggest assets is in stocks and other assets. But for Coinbase, that's really all they have. So I don't see they coming out of this hole anytime soon. Anyway, following up on more of a Gringy view, I'll talk about a trade that I actually got into on Friday, and I ended up actually getting out of it this morning. But I'll get onto that later. The stock is PGNY. Okay, it's Progeny, I think that's how you pronounce it. What they do, they are fertility solutions, kind of clinic. They offer various services to up and coming families, and especially people who have a hard time, getting pregnant and so forth. It is pretty small. It's a $3 billion market cap company, and earnings are due in February. And in this type of market that's been really all over the place, a lot of these smaller cap companies that are not really bankrolled too well are kind of on thin ice. And I think this is one of them. They claim that they use like a more holistic, data-driven approach, like next level type of stuff, a little new age. But it hasn't really panned out. So the stock peaked in late 2021, but the rest of the market, a lot of other stock peaks around that same time. So that's not really that big of a deal. But if you look at just look at the trailing fundamentals, which I have on this chart, you'll see revenue looks like it's doing well. But the bottom line, as in earnings per share, which is the green line here, has been kind of falling off a cliff. And that's been companies that have that profile in this type of market environment are having a really hard time, unless they are large cap companies that's been around for a long time that can kind of weather the storm. So there's a lot of focus now on bottom line growth. In a kind of a steaming bull market, we can find stocks with solid revenues, no earnings, and they can still do great. But that's not really the case these days. So we want to see strong potential for solid future earnings for companies now, and this is just not happening here. Okay, so I'm showing you a graph of the consensus EPS revisions trend going forward, and it's just been crushed. Basically, it was at 27 cents for Q4, earlier this year, really. Now it's at 2 cents. So it's been dramatically cranked lower. And also the last quarter, numbers are mixed for the company, despite upsides. but that was, versus the consensus at the top and the bottom lines. So like I mentioned earlier, sales have been doing well. Okay, over 200 million last quarter. It was actually the first quarter ever to reach that, and they also had an increase in client base. So it's not all bad news, and it might not be that apparent. But if you look a little closer, you'll see that there's been a recent contraction in bottom line fundamentals and profitability. Okay, and that suggests kind of that the downside is warranted, really. And I'm showing you a graph here of this is the ROE, so return on equity. It is in orange. It's just getting squeezed, getting tighter. And so if you look a little further at the numbers, the gross profit increased 61% year over year, okay, to 46 million in absolute terms. But they also had stock-based compensation that increased 226% year over year to 23.3 million, and it was 7 million about a year ago. So what that does is that it just caps the upside gross margin. So margins are getting compressed, ROE is getting squeezed, and management will also lower their future earnings potential that they're talking about. And it's also pricey. In a market like this, valuations matter. And they have a trailing P of a bit over 80, forward P 64, but getting higher as estimates are getting cranked lower. So on a valuation base, it's still pretty stretched, even though the stock price has been coming off. And let's not forget about price to sales, which is over 4 times here, which just doesn't work well in this, in this market environment. These are the times when people kind of stick to the old proven models that's been around for a long time. This is not really an environment where, people are into trying new stuff. And so I was looking at this last week. I actually ended up getting into this on Friday. And you can see the options chain from this options chain is from Friday, actually. And I was looking at either the 30 or the 35 puts straight up for January, kind of like what Raj is doing with Coinbase. And the reason why for a short play, it might, it's often a good idea just to go straight up long puts, is because when stocks fall, they tend to fall really hard and fast. And in that case, you're better off just being long puts usually. So I ended up actually buying the January 35 puts at 290 because that's where we had open interest and the bid offer spread was tighter. And at that time, it was near the money. Now, keep in mind, this was last Friday. I actually got out of this trade this morning at 6. So I got into the 290 on Friday. I got out this morning at 6. That's over 100% profit in a few days. I have the options chain for today on here as well, and you can see that the high is 6. Now, we're not short-term traders really. We typically hold positions for weeks, even months. But if I can get 100% profit in a few days, I'm inclined to take it, and just move on to something else. So this trade has already basically played out for me, but I definitely think there's more downside, and I might actually get back into it on the short side, potentially, next week, see if we can get a little bit of a rebound. So that's what I have on that one.
Brilliant, good stuff. Raj, let's go back to you. Have you got anything else?
Yeah, back to just to touch on what Ben said. That's Progeny is a company that actually does relatively good things. I think most people would argue that people that have trouble getting pregnant and doing a good service, but just because it's a good product doesn't make it a good company or a good stock. And maybe people, there's a recession, people want less babies. I don't know, but. Speaking of the opposite end of that spectrum, there is a name that I've had my eye on that I've accumulated a position in, and the company the ticker is XPOF. It's Xponential Fitness. So this company is the largest global franchise of boutique fitness brands across a bunch of verticals such as Pilates, bar, which is the workout with a ballet bar. cycling, rowing, dance, yoga, running, boxing, functional training, stretching, basically all the new type of fitness gyms that have come to become popular in the last couple of years. As you can see, if you look at the business mix here, they've got on this chart right here, they've got 10 brands, and they're growing inside of their biggest brands are Club Pilates, which has 750 locations, Pure Barre, which is 621, Cycle Bar, which is similar to Peloton or Soul Cycle, Stretch Lab, which is just they do stretching, Body Fit, the BFT. All those three have over 200 locations, and as you can see, they've got over 2,000 locations around the world right here in these different products. So it is a bit of a diversified gym product rather than just one, which actually I'll go into a little later, but allows for diversification. And given the fact that some of these fitness programs are fads and trends, that they're good for a while and they go away, but this should allow them to survive in that. But before we get into that, let's talk a little bit about the quantitative elements. So the stock's trading around $22 as we talk about this, trading a little over $1 billion of market cap. The PE is just slightly positive now. It's just they just turned a first profit. I'll go into that. They don't have a dividend yield, but this year they're actually up 6% year to date. So they've actually bucked the trend, and that's especially impressive given the fact that not only the market's down, but anything in consumer discretionary is really taking it on the chin. So with that, let's go back and look at their recent Q3 earnings, which was on November 10th. Like I said, they reported a 10-cent profit, which was their first profitable quarter ever, even though their expectation was 12 cents. Still having their first positive quarter, profitable quarter, is obviously a big turning point in the company's business. They reported $64 million of revenues versus $55 million of revenues, which are their expectations. And if you look at year over year over that quarter, the revenue grew 56%. They upped their guidance for the full year of 2022, even though there's only one quarter left. They raised it to 235 to 240 million of revenue, which the previous guidance was 210 to 220 million. And again, like I said, that's only going to be due to the fourth quarter revenue, since they just reported Q3. If you look out to next year, this is very interesting. The analyst estimates are so wide, you could drive a truck through them. Their analysts are expecting anywhere from 27 cents per share to $2.02 per share. So what that means is not only is with the uncertainty, that kind of wide range of earnings per share will likely lead to volatility in the stock price. So given that, if it reports on the high end, it could have a massive upside move. And also when earnings estimates are that diverse or divergent, I should say, then it's a good reason to trade options on this, because if you're right, you can be really right. If you're wrong, you only lose your premium. So, and also they're expecting to grow their top line revenue another 30 to 50%, even in a what most CEOs are. I saw a thing this morning with 98% of CEOs were expecting a recession in 2023. So for them to expect to grow that top line revenue in this market says something here. So some more highlights from the third quarter. If you look at their same sales, their North American same sales growth was 17%, and their run rate AUV was about 490,000, which is 3% above their pre-pandemic levels. If you know what run rate AUVs is, it means the average unit volume, and that's calculated by dividing these sales per store open for a 52-week period divided by the number of stores open during the prior 52-week period. So basically, it's a long-winded way of saying it's trying to isolate COVID disruptions and not factor that into the numbers, and basically get rid of that obviously what disrupted businesses for years, and hopefully it's a thing of the past. Another thing that was interesting was the franchisee showed a willingness to open more studios even with these recession fears. I mean, does that mean that Main Street is more bullish than Wall Street? Maybe, or maybe they have more of a risk appetite. I thought Wall Street was supposed to have risk, not Main Street, but this case in point was actually the opposite. So if you look at the last week of September alone, they opened 36 studios all around the country. So that's, and if you look at if you look at for a full year, they're expected to open somewhere between 500 and 520 units as a whole this year, which is about 25% of their total stores. So obviously it's a big growth, and it's looking to continue. I mean, obviously some of it could be because of COVID, given some of them might have been delayed. Maybe they're supposed to open in 2020, 2021, but either way, it's definitely a positive. And since last earnings report, both B of A and Citigroup have upgraded their stocks and raised both their EBITDA and their revenue expectations for next year. So looking a little bit closer into their business, they've established themselves the market leader in the fitness space, and they're now profitable. Big thing is their asset light model versus something like Planet Fitness or these other big box gyms. That allows them for a quick scaling of the business and recurring revenues, which help minimize their recession risk. It's not a huge investment in buying expensive equipment for them. It's certainly less, and it allows them to open quicker because of supply chain issues and all that. And one thing that's been interesting is they're seen as an acquirer of choice amongst the emerging fitness brands. So they're not only are they growing, the people that are have like these niche brands are actually looking to XPOF to be absorbed into their universe rather than vice versa, which is actually interesting and somewhat not the way acquisitions are generally made. It's usually coming from the big guy trying to acquire the little guy. So I think this has allowed this to be, in my mind, a short-term momentum play in the discretionary space, because there are very few companies with any momentum at all, with any kind of growth. This is one of the few ones that I've been able to identify, if at all, that has that. So if looking broadly, if you just want to use this as a good long pair play versus many consumer discretionary stocks that you think you want to be short that can easily be justified, I certainly think it fits into that, even if you are bearish on the consumer. And as a long-term play, which I do believe it's more of, I think it's not just a short-term long, it's a long-term long. This company is going to capitalize on the tailwinds of the fitness industry. Like looking closer at the EBITDA and the compounding annual growth return, they're expecting 30+% over the next few years, and I think that's actually low given like their international expansion, their potential for new brands, and their partnerships, which I'm going to talk about a little bit right here. Like just recently, this week, they signed an MFA agreement in Japan for 2 of its brands, and that's going to allow that franchise partner to license a minimum of 100 studios over the next 8 years in Japan alone. So with that, they'll have studios in Australia, the Dominican Republic, Mexico, New Zealand, the Middle East, plus Japan, US, and Canada. So that's a total of 14 countries and growing. So in terms of catalysts, besides the international openings in new countries, they've got potential for more niche fitness concepts and that they've shown a willingness to cross-sell and cross-franchise. For example, on that is they've established corporate partnerships with companies like Lululemon, which was just announced. They've done partnerships with energy drink companies like Celsius Holdings and C4, and they recently they have an arrangement with the Princess Cruise Lines, which allows them to develop their brands on their cruise ships. So I guess the idea on that is let's get fat eating all the buffet food on those ships, and then let's get stretched out and do Pilates, and then so you can really pig out. But anyway, the point is these partnerships are there in their infant stages, and these other potential deals are going to add growth, brand awareness, and customer engagement and retention. So the bottom line here is, to me, the risk reward is very favorable. Given XPOF's strong unit growth and strong visibility into new studio openings. They've got great franchisee economics, which I actually looked at myself just for my own curiosity, and strong brand momentum across the 10 fitness concepts. The business is very scalable. They've got first mover advantage, and they've got much. And what's interesting is that much higher margins than their comps, like something like Planet Fitness, and they're growing their profits at a faster rate. Interestingly, though, if you compare Planet Fitness to XPOF, XPOF is trading a significant discount to a company like Planet Fitness, not Planet Pizza. But Planet Fitness is trading at around a 90 PE. And, you may think that's a short, but I actually don't think it's a short given some of the industry tailwinds. But XPOF is actually in the fastest growing sector of the fitness industry, in that niche industry. And I think we'll have a more resilient customer base, even in a recession. Because most of their workouts are not offered in big box gym classes or home gyms or gyms in buildings or hotels, which are very popular now. So you almost have to go to these places if you want to do these type of workouts. And finally, and obviously one of the risks is, some of these workout concepts fall out of favor because we all know, the fickle nature of customers. Some of these workouts are fads, and some of them will disappear. But the diversified portfolio will soften this. I mean, I can remember fitness concepts. I'm sure Ben does, like Tybo, or Billy Blank's, Zumba, aerobics. My favorite one for a while was pole dancing and stripper aerobics. All those have went the way of the dodo bird. But given this given that they have many brands, even if they lose some market share, they lose one of them goes away, they'll have other ones to pick up the slack. So this has got a huge TAM, a total addressable market, and it's got a huge growth runway. I mean, longer term, I would expect this to have a multiple re-rating, and could I see a 300 to 400% increase in 3 to 5 years? Absolutely. So to me, it's not just a name for the short term; it's a name for the long term. So in terms of how I'm trading it, the structure, their next earnings are on February 9th. Like I said, I might be early on this name, and maybe this is a little bit too soon. But I'm looking out to buy calls out in April. And keep in mind the options here, which just aren't that liquid, and sometimes that happens in names that you like. But I just simply like buying the August 22.5 calls for $3. That's a little over 4 months out, and if the stock gets to a 50% rally from here to like 35, it'll be a greater than 3-to-1 risk reward. As the stock starts rallying, perhaps if you wanted to take some money off the table, maybe you saw some upside calls against it. But again, this is a name that both for the short and the long run, I think is very interesting, especially versus the trouble is to find anything positive in the consumer discretionary space.
Yeah, I think you hit the nail on the head with that last point as well there, Raj. Ben, let's go back to you again. Have you got anything else you want to share?
Yeah, Raj, you forgot about the shake weight.
Oh yeah, the shake weight. Yeah,
remember that fad?
I remember that one.
So, all right. So I got two very quick ones. Okay, and they're kind of like a pair because they're both in the commodity space, and these are not super in depth. All right, so gonna keep this pretty fast. Now I look at commodities. I look at various futures contracts. It kind of keeps me in tune in what's going on with not just the stock market, but the overall economy and other aspects of the market. And the stock that I'm long here is Nucor. Okay, Nucor Steel. Now Nucor isn't, it's a fairly large cap. It's not a small cap, mid to large cap company. But the story here really is rock solid fundamentals, increased demand for their products, and very stable climbing revenue and EPS history that also have a history of expanding. Now, really, the one thing that I look at a lot too is iron ore prices. Now, why do I care what's going on with iron ore? Well, it's because iron ore is kind of it's a based metal for steel and other structural metals. And I have a chart on here for iron ore, and it has bounced from almost 80 to basically 110, okay, in November. And you kind of say, okay, so what? Well, that tells me that there's a kind of rebound in demand for infrastructure type structural metals. And also, the dollar, which was on a tear up until like mid-year or so, the dollar is now in a downtrend, right? And we're seeing that the dollar kind of trickling off, and a weaker dollar is bullish for metals as well. And also we have the kind of the unwinding of the COVID lockdowns in China. That's kind of more tailwind for this type of trade. Now, I also happen to think that we either are or will soon be in a global recession, and the chances are that we'll probably get out of it sometime mid to late next year. And so anyway, if you look at this stock, fundamentally Q3, the results were better than previously pre-announced guidance, and they also have a solid investment grade balance sheet. And this year, 2022 is actually supposed to be a record year for the company with over $9 billion of income likely. So this company is pretty much firing on all cylinders, has a ton of tailwind, and is just more from like a technical view. Stock went sideways most of the year, but kind of showing signs of higher highs, higher lows, and could kind of break out of this range that we've been in most of the year. So I have a longer term horizon here. Okay, so I'm looking to structure this out in April. So I'm doing this as a vertical ratio spread, and where I'm buying the April 160 calls for 12.9. This is the chain as of yesterday, by the way, and I sold half that amount of the April 180 calls at 6.4. Now the total for one structure then is the 1290 times 2 contracts times the 100 multiplier, which is 2,580, so 2580, and it's 2 because it's a 2-phone ratio. Okay, this is of the April 160s, and then for every 2 that I bought, I also sold 1 April 180 at 6.4 for a $640 credit per structure. So then the total expense for one of these is $1,940, which is the risk here. Now, the reason why I'm doing this as structured this way versus just a straight up call, let's say, is because first of all, this is out in April, and that's pretty far away. There's a lot of time value built into options that are 4 to 6 months out. So I want to hedge out some time decay. That's why I do it as a ratio. And also, when the stocks climb, they don't usually take off like a rocket. Okay, especially big commodity companies. They kind of grind higher. So while that's happening, I'm happy to sell some calls against it. So this is kind of almost like a covered call play. And also, in case something happens and there is a massive upside move, I have it as a ratio, so this has unlimited earnings potential at the same time. So, so that wraps up Nucor. And the other one that I'm looking at as a short in kind of not the same space, but it's in the commodity space. Okay, and it's AR. I actually just shorted it. I did this trade this morning where I just bought puts. Okay, AR is Antero Resources, and it's a $9.5 billion market cap company, and it's in the natural gas space. Okay, similar to LNG. Now this is mostly a play on falling natural gas prices due to lower demand expectations, and I have the natural gas chart on here, and you can see it's a pretty perpetual downtrend, and especially this week, there's been some massive selling. And I wouldn't be surprised if it kind of stabilizes, but then it's likely to continue. So another tailwind here is the restarting of the Freeport LNG terminal in Texas. There was an explosion this summer that kind of put that whole facility on hold, and they're supposed to launch it. I think it was about a month ago. Only that didn't happen. That got delayed. So this is kind of been a thing in this space, and a direct trade would obviously have been LNG stock, which is another potential short candidate, maybe the more obvious one. But because of this whole shift in the reopening agenda, it makes it more volatile, and just more unpredictable. So that's why I wanted AR instead. Now, AR is not really a bad company per se, but with the LNG catalyst, nat gas prices falling like a rock. I think that's enough to get this stock to head lower, right? So it was just, their earnings was actually just getting into the green this summer. I have that on this chart where you see kind of this red squiggly line, which means that our EPS on a trailing basis was like red, green, red most of the time, just turned green. So it's been all over the place. Okay, so there's large fluctuations here in the fundamentals. Okay, and it's a cyclical, but still, it's just all over the place. And with what's happening now, the market does not like uncertainty. So companies like this with really fluctuating fundamentals are likely to get punished. I kind of did this trade the same as I did the PGNY, where I just bought the Jan 30 puts at $2. Okay, so the price target, the way I'm looking at it, is would be around 20. The stock is at 20, okay, by the January expiry. And if that's the case, these options will be worth $10, and that's a 400% return. And this has limited risk at $2, unlimited profit potential. So we'll see how that goes. But so I like to, a lot of times do these pairs, and it kind of protects you a little bit in case one gets really wonky. Because yes, they are in different materials, but they're still both commodities. So they're both somewhat impacted by the dollar and supply demand, obviously. So that's a wrap for these.
Awesome, guys. Well, that brings us to the end of the episode. It's been great to hear from you both, as always. It certainly provided me with lots of things to think about trading into 2023. I'm sure it's done the same for all of our viewers. So appreciate you guys coming on the show. Now, for all of you watching, I hope you enjoyed that episode as much as I did. That is, in fact, our last What's on Your Mind episode of this year, 2022. But it's not your last chance to get involved with ITPM. We're running a holiday discount program for all of our educational courses. I'm going to put a link to that below the video in the description. Basically, there's lots of savings to be had on our courses, so it's a great time for you guys to get involved, and we hope to see as many of you as possible in 2023. Anyway, I'm going to leave it there. ITPM's had a great year in 2022. I hope you guys all have as well. And like I said, we look forward to seeing as many of you as possible next year in 2023. So for now, happy holidays. And we'll see you early in the new year for another episode of What's on Your Mind.